Welcome to 3 and 3. My name is Jason Weaver and Happy New Year. Today we're going to be starting with the 2026 outlook, the S&P targets, bond interest rates, and again, forward projections on where rates are going. So S&P targets range between 7,500 and 7,800. Morgan Stanley right now leading the pack of large institutions at 7,800 and JP Morgan and Wells Fargo at about 7,500. If you look back to the end of December 31st of 2025, the index traded at 68.46 with a forward PE ratio of about 22 and a dividend yield about 1.4% and a 10-year treasury bond at 4.2%. So historically, looking at previous PEs, we're going to need a lower interest rate policy and lower 10-year bond to support that forward PE or very fast earnings growth and GDP. So fixed income for 2026, the market environment is calling for 3.75 to 4.25 on the 10-year treasury. Federal Reserve is between 2 to 3 rate cuts in expectation, which again, a cautious approach due to sticky inflation, and Powell's term ends at the end of May. The yield curve, potentially some continued steepening, and short-term rates will fall faster than long-term rates due to the Fed's policy. Investment positioning, again, current yields remain attractive. Investment grade corporates at about 5% or so. Triple B rated, which are still investment grade, between 5 and 5.5%, near upper end of a 15-year range. Strategic focus favor intermediate duration between that 5 to 10-year range. Emphasize quality over yield. Returns driven by income, not price to gains like we did last year. And credit spreads tight, but justified by fundamentals. The 10-year treasury yield, as you can see, going back to October 2018 was about 3.2%. We had that pretty precipitous drop with COVID down to July of 2020 at 0.56. And then we've had a pretty steepening curve all the way from 2022 as the Fed started raising interest rates. And now you can see we're trading in a sideways range with the 10-year now at about 4.2%. So interest rates, the current landscape again on the Fed fund rate is 3.5 to 3.75%, and that's 175 basis points of cuts in 2025. The key constraint again is inflation remains above the 2% target, but the labor market is showing some cracks. The 2026 outlook again, there's 2 to 3 cuts, but we expect again maybe 1 to 2. 3% is the projected terminal rate. And key developments for 2026 with rates are Powell's term expires, extended pause likely and early in 2026, and 3% of used as the more neutral rate. So bottom line, 3% represents a structural shift from the 2010s. This isn't a pause in the cutting cycle, it's the destination. The era of near zero rates is over. So look at the federal fund rate from December 2015 to December 2025, and you can see the Fed typically has this a little bit wrong. As the Fed's raising interest rates, what generally happens is we start to slow the economy a little too fast. We get a recession. Now, COVID might be something that was very different. We stay flat for some time, but typically that time is a little too long. And then the Fed has to raise rates pretty precipitously. So going forward with the new Fed chair, we'll see how he actually determines where rates are going. He's actually said that he believes that rates are too low for Wall Street, but too high for Main Street. So we'll see how that equates to the market and the general view of the Fed in mid to late 2026. So the real purchasing power, so the hidden cost of safety. So since 2000, inflation has eroded the purchasing power of cash by 47.8%, turning a nominal $1,000 into just $522 of real value today. So we need resilience over volatility. Despite 3 major big bear markets, the S&P generated a 294.5 real return, growing that same 1,000 to 3,945. And the cost of waiting gap, the advantage of staying invested versus a shift, is again a major difference if you just stay invested. So again, we thank you for watching 3 and 3, and hopefully you have a nice 2026.